Cześć, Artur Wiśniewski, Stockbroker.pl. Witam Was serdecznie na Pasywnej Rewolucji i zapraszam na moją rozmowę z Tomem Bailey z HANetf o tym, jak inwestować w spółki z sektora obronnego, które są aktualnie najbardziej popularnym tematem inwestycyjnym. Hello Tom, thank you very much for accepting my invitation to Passive Revolution Conference.
Thanks for inviting me.
Could you tell us very shortly, what do you do?
Sure. I'm head of research at HANetf. So to explain what I do, it's probably easier to first explain who HANetf are. So we're a white label ETF issuer. So what that means is we partner with third-party asset managers to bring ETFs to the European market. So this can vary. Sometimes it's a US asset manager who has a successful ETF business in the United States, and they want to enter the European market and create ETFs in Europe. Now, rather than starting their own ETF business, they'll come to us, and then we'll launch, create, and distribute that ETF for them. Or increasingly, it's European asset managers who have not gone into the ETF market yet, are still running, say, your traditional mutual funds, but they see the future essentially is ETFs. So they're looking to launch ETFs, but they don't have an in-house ETF capability, then they'll come to us. And my role fits in as head of research. Essentially, it's to understand these different themes, and it's to support the distribution function of that. So it's understanding, the investment case for the different products and communicating them to investors.
Thanks for introduction. You have recently listed Future of Defense ETF on Warsaw Stock Exchange. Can you tell us in the beginning very generally, what is NATO? I mean, Future of Defense, this is the ticker of this ETF. What stocks does this ETF invest in?
Sure. So, it's ultimately a defense ETF, as the name suggests. So there's two kind of parts to that. The first is you're trying traditional defense companies. Obviously, they're very tech orientated. It's not to call them kind of old, but those kind of producers of military equipment, industrial companies. So this is your Rheinmetall, your BAE Systems, your Thales, your Leonardo. And that's a key part, obviously, of the defense theme, and obviously major increases in military spending and sales for these companies. And then at the same time, we have a cybersecurity component, given the importance of cybersecurity, which we can kind of get into a bit more detail on a bit later. And so we have this kind of what we call thematic ETF. So obviously, we want to capture the defense theme, but as a theme, not just as a sector. So what we're looking at, obviously, is this world of greater geopolitical risk and volatility, increased defense spending, security spending around the world, and then we're trying to capture that in a thematic way with this ETF. So we listed this ETF first in London and Germany back in 2023, and saw some good success in terms of investor demand and also strong performance. And then this year, as you mentioned, we listed that on the Warsaw Stock Exchange as well.
Okay, I forgot to add that in the backstage we have a presentation of yours. So if you like to expand what you say with graphs, just feel free to use your presentation.
Yeah, sure.
What I wanted to ask, because you said it invests in different stocks. So many people might ask themselves, it sounds like benefiting from war, which may be considered immoral. And I have heard many times that investing in, for example, gun manufacturers is against ESG principles. So who is wrong? Is it bad to invest in defense stocks, or maybe ESG is bad?
Yeah, so there's several parts, I think, to that question. So the first, benefiting from war, in a sense, yes, right. But at the same time, it's not necessarily, that doesn't necessarily need to be seen as something condemnatory, right? War exists in the world, fear of war exists, and governments need to equip their militaries. We don't think of, say, if you take a company like Novo Nordisk, right, a drug maker, they produce insulin for diabetics. Diabetes exists. They produce a product which addresses that need. And obviously, it's a commercial enterprise, and that's the most efficient way to produce stuff under capitalism is our understanding. And therefore, obviously the company and therefore shareholders of the company benefit from selling the product to address an ill, diabetes. Likewise, insecurity, geopolitical volatility, fear of war does exist, and therefore militaries are simply the same. We don't doubt the need for countries, at least most of us don't doubt the need for countries to have a military capability, and obviously in Europe now more than ever, that's understood. And it's simply, it's the way that military equipment is procured. We rely on the private sector to do the research, the development, and produce these products, and then governments buy them for what we do think is a societal good. even if the root cause of that need is itself an ill, i.e. war, but war is a constant throughout human history. One day, hopefully, it can be done away with, but that's not the case today. And so, we don't think investors should necessarily feel that kind of, benefiting from war. It's simply the reality of the world, and is an investment case in the same way lots of other ills produce commercial opportunities, and the commercialization of the solution to that is actually often sometimes what produces the best products for it, right? Obviously, if we're relying on the state to produce everything, it wouldn't work, or would be substandard at least. And so that's kind of how I think about that benefit from war aspect. It's simply the tragedy of the human world that these things exist, and therefore solutions for them have to exist as well. In terms of some people might have a more aversion to owning defense stocks on a personal level, and that's totally fine. Like, they're not going to necessarily want to invest in our products, but at the same time, as I said, the kind of need for military equipment, particularly in the world we're in today, is true. But we shouldn't necessarily take from that it's okay to invest in any arms maker, right? So while it's subjective, I think most of the audience would agree that they would find it morally questionable to invest in, say, Russian arms companies right now, or ever. So at the same time, you have to take that into account for our own, a sense of what's right as well, but also what investors want. And so we have stuff like, not that you could invest in Russian armed companies right now anyway, they're all being sanctioned, but we have, say, for this ETF, what we call the NATO screen. So companies that can invest in this, companies that can be included in this ETF can only be included if they are domiciled in a NATO or a NATO allied state. And we think that goes some way towards addressing some of the ethical concerns investors might have, that these are companies based within NATO or NATO allied countries, such as say South Korea, and therefore investors are at less risk of having exposure to a company which is selling arms to a geopolitical adversary. Obviously, we kind of know who we're talking about there. And then at the same time, the ESG aspect comes in too. So with ESG, it kind of means everything and nothing at the same time. Sometimes it gets talked about in very broad strokes. If ESG is simply used in terms of investments which help decarbonize the world or something like that, it's not ESG. But that's not really necessarily what ESG. That's kind of what ESG started to sometimes be referred kind of thought as. But actually, ESG is simply the incorporation of non-financial risk metrics to your decision-making process in investing, right? So these aren't companies which are going to help with decarbonization, but you can still apply somewhat of an ESG framework to investing in defense companies. The first simply being, the location of them, as I mentioned, with this NATO screen, from that kind of ESG risk management perspective. Having exposure, say, to Chinese defense companies is very risky. Some investors might find it morally questionable, but you would also then open yourself up to risk around, say, sanctions, were there to be some sort of development in the Straits of Taiwan or South China Sea. And so it's also that risk mitigation. And that's really what ESG is about. It's, in a kind of conventional sense, it's about not having exposure to companies which are going to essentially be penalized in a world of moving away from fossil fuels. That's kind of one aspect of it. Or companies which have poor control of their supply chain and therefore might end up having major fines for poor water management or having questionable practices in the supply chain. And so that's the kind of other aspect. And you can apply that to defense companies. We don't necessarily to the carbon aspect, but you want that S in a sense. So we have a very light ESG style screen on this, where it's just OECD best business practices to ensure that these companies which have transparency and are fairly confident around avoiding corruption scandals. And that's that is ESG really. We don't necessarily call this an ESG product because that's kind of where the market is. So to kind of bring back to your question, because at various different points, look, defense has been a controversial area. In that kind of, as ESG has been understood, it's one of those kind of automatic exclusions. Historically, it's changing now. We think that view is changing. And then at the same time, you can still apply that kind of ESG style analysis to defense stocks, and maybe in some ways it's more important to, given the controversies that could arise if you were to invest in some certain defense companies.
And you said that investing in Russian stocks, defense stocks, would rather be considered wrong. But what about Chinese stocks?
Yeah, so we don't offer in terms of defense stocks. We don't have any exposure to Chinese defense stocks in any of our defense portfolios. There is obviously some investors simply would find it morally questionable, but there is that big risk, right? There's that sanctions risk. These companies obviously are key suppliers to the People's Liberation Army, and if anyone's following the world and geopolitics, there's growing concern around what China's intentions are towards Taiwan or its neighbors in the Philippines over the disputes over the South China Sea, and so very much don't think investors want exposure to Chinese defense companies. Essentially, I think it's too risky, or if they do have the view, morally questionable to do so.
The idea of the fund is to invest benefiting from government war spendings, but we actually already know that these spendings are higher. So how can we know if this information is not already included in prices? Is there any space to grow in future for such ETFs?
Sure. So obviously, you kind of mentioned, the increase in defense spending. We have here. So last year, defense spending increased by almost 10% compared to the year prior. Every region saw a jump. Europe 17%, and that's before all the different defense spending pledges from Europe this year. The change to the NATO rules. Obviously, NATO now has agreed by 2035 to go to 5% GDP on defense. Poland's already there nearly, but the rest of European NATO is still way behind. So there is still that momentum for growing defense spending, despite the strong spending this year already and last year. If we take those kind of projected defense spending figures, this is from Morningstar. You can kind of read the paper, projecting essentially where those that 5% goal or 3.5% goal. So maybe I'll just explain the new NATO budget. So NATO has agreed to spend 5% of GDP on defense by 2035, but that's split into two components. There's your traditional conventional military expenditure, which is set at 3.5% of GDP by that year, and then 1.5% for broader societal preparedness, which includes stuff like cybersecurity and industrial resilience. Now, if this is Morningstar's projections, they project that if we do start to see that increase up to 3.5% GDP on conventional defense, and then also you'll see within that equipment budgets grow. So when you're looking at defense spending and the investment theme for defense, one of the very important things to look at is how much of what's being spent on defense is actually going towards equipment, because ultimately that's what creates the investment case, right? More money spent on recruiting soldiers and food for the soldiers and pensions for the soldiers doesn't necessarily translate to an investment case. What matters is the equipment expenditure. Very interestingly, if you look at the percent of military budgets in European NATO, last year Poland's defense budget was around 50% of that dedicated towards new equipment spend, highest in European NATO. And so if you take these kind of this European rearmament theme, we'd expect other countries in Europe to kind of follow Poland's lead. And so you can see here these projections from Morningstar of defense budgets. So you can see that there's kind of split between what's going on equipment and what's on the Romanian defense budget. You can see it starts to increase to 50% of GDP towards the end of this decade. And in the tail off, obviously, once you bought equipment, you're not going to necessarily have staying at 50% of GDP, but still relatively high. And that Morningstar estimates would lead to an extra 1.7 trillion in cumulative defense spending by 2035. So it's a huge figure, much bigger than annual global defense budgets, defense company revenues on a one-year basis than now. So that's a huge figure. And obviously that kind of sets me up then for the point around valuations, because obviously if the audience will be well aware of this defense theme. It's been in the news a lot. If you simply just read the news, you're seeing the increased spending budgets, etc. I assume it's covered as well in Poland as it is in the UK, etc. And obviously the strong performance of a lot of the defense stocks. So there is now a question around valuations. We have seen valuations expansion on the back of these expectations. So if we take a look at our ETF, the NATO ETF, I've got the multiples here. So we look in the column, the fourth column, best PE. That essentially, we can see for the ETF is trading on almost 27 times 12 months forward earnings revenue, which isn't huge, but it's not cheap, right? But at the same time, we have to keep in mind, as I mentioned, the ETF itself has cybersecurity companies in, American tech companies, which do trade on higher multiples. These obviously those kind of classic growth stocks. So if you just look at the industrials, which account for about 60% of the portfolio, they're trading on about 24 times. So still a bit pricey, but you get closer to kind of the market average there once you look at just the industrials. But still, for defense stocks, industrial stocks, they're still relatively high. But the point is, you pay for growth essentially. That's why they're trading high. That's why the valuations are higher. It's for the expected growth. So if I look here at the index of the ETF, we can see. Also, very kind of builder text. But if you go right to the right hand side, you can see there's 3-year growth estimates. We think that's key. So 3-year growth estimates for our basket of stocks: earnings per share expected to grow 75%, sales expected to grow nearly 60%, and EBITDA almost 75%. And we think that's the kind of key is that strong growth rate is what investors are paying for now. It's more expensive than it was a few years ago, but that's essentially the story and why investors are willing to pay those prices today.
You said already that this ETF invests in different types of stocks, but let's step at this point a little bit longer and look at it a little bit deeper. What sectors are these stocks from, and how much of their income depends on war spendings, and what is actually their nature? Are there more like growth stocks or more like value stocks?
Well, on the growth versus value, a lot of the stocks in the index a few years ago look like value stocks. They don't look like value stocks anymore. They look much more like growth stocks today. But in terms of looking at the sectors we capture, we can explain the index construction. So the best way to think about it, I think, is to think of the ETF as having 2 buckets. You have kind of your traditional industrial defense bucket, and then you have your cyber defense bucket. So the way we capture those 2 different buckets is very different. So the first one with the traditional defense bucket, the industrials, basically they derive more than 50% of their revenue from selling military aircraft, armored vehicles, missiles, munitions, or naval ships, electronic systems, these kind of areas that you'll be familiar with, drones, etc., for military purposes. And so we're getting that very pure play exposure. We're not looking to get exposure to something like Boeing, which does sell some military equipment, but actually most of its revenue comes from the sale of commercial aircraft. Not interested in including stocks like that, not for Boeing's own particular purposes. It's an index. We're not taking bets on individual stocks in that way, but simply, its main driver of its stock price is not going to be increased defense spending. So we look at that pure play approach when we come to traditional defense stocks. Now, when we come to the cybersecurity side, it's a bit more complex because essentially, if you did this revenue screen, you'd end up with nothing in the basket. So we don't necessarily want to do that. So instead, we thought about how we can do this and actually capture the theme. And the best way is really, we're looking at cyber defense companies, but we're making sure they have a contract with the NATO government for providing their cybersecurity services. Now, you could then say, well, that's not very pure play because the bulk of their revenue might be coming from the private sector, from a insurance company or a bank or whatever. You might think contracting with them for their cybersecurity purposes. But the key point of understanding the cybersecurity element is understanding that cyber attacks are often geopolitically driven. So you can see some of the attacks in the past few years on the Baltic states, obviously sponsored by Russian hackers. Often you get this geopolitically driven cyber attack, but it targets actually the private sector. So it targets financial infrastructure, energy infrastructure, but these are private companies. So they're paying for this cyber defense, protect themselves from this geopolitical volatility, but it's not going to come up as government spending in the same way. So we can't screen for that in that way. One kind of good way to think of it, I think cybersecurity is quite a unique area in terms of this whole defense kind of complex. If you have an oil installation in the sea, right, defending it against a physical assault is the responsibility of a government, and the government pays for the military, the navy, to do that, and that's all paid for, and it's just kind of assumed that the BP or whoever with that oil installation is protected from the government by the state doing its duty of protecting it from attack from hostile enemy forces. But the computer systems on the oil platform are not protected in the same way. They exist out there, obviously, in the internet, so to speak, But if they're hacked, protecting those from geopolitically motivated bad actors through cyber attacks falls into the domain and responsibility of the company itself. They pay for it, coordinate it themselves. Obviously, sometimes some assistance from the government for sensitive stuff, but ultimately it's they will go contract with Cisco or Palo Alto Networks to pay for that cybersecurity. And so that's why we've not included the revenue screen in the same way, because we don't think it really captures that cybersecurity aspect of the defense complex today. So that's the two buckets. Sorry, long-winded way of explaining. We have our military, kind of traditional military equipment makers, and our cybersecurity companies. Typically, the balance is around 60% to the industrials and then 40% to the cyber. But then to be included within the ETF, they have to be, as I mentioned, domiciled in a NATO member state or a NATO allied state. The US keeps an official list of major non-NATO allies, includes countries like Japan and South Korea, so they can be included as well. And then we have the other screen I mentioned, the OECD guidelines for multinational enterprises, kind of just guarding against corruption and stuff. And then obviously we weight them. It's market cap weighted, but we have quite a strict capping limit. So no single stock can exceed 5%, because we don't think investors buy ETFs to have their portfolio crowded out by a handful of big names. And then at the same time, no single country can exceed 60%. And obviously what we're talking about there is the US, and trying to ensure some global diversification, which obviously has been pretty positive for the ETF, given the performance of European defense stocks over the past year.
In the end, I would like to ask you about the risk of peace. I know it may sound silly, because when we talk about war, we hope it will end and that the peace treaty is reached. But let's imagine that Russia and Ukraine reach a peace treaty, or China and USA, they agree and they have a new deal, and finally they stop the war spendings. So wouldn't be it a threat to such ETFs like Future of Defense, which invest in defense stocks?
Yeah, I mean, look, the first part, which is obviously the most immediate and potentially likely, or I think relatively low likelihood, but maybe we'll see, is obviously some sort of conclusion to Russia's war against Ukraine. Look, I think it very much depends what that peace looks like. It is a key part of that. You know, we're well away from it now, but we've seen over the past 6 months or so various different iterations of US kind of sponsored peace plans and what they look like. And we can see in that, you know, the inclusion of recognition of, say, Crimea as part of Russia, obviously being annexed and occupied since 2014. Potentially the inclusion of Donetsk and Luhansk, and maybe Zaporizhzhia and Kherson. Also potentially partially or fully being recognized by the US as Russian territory. This is I think, you know, this complete rupture with the post-war era. If that's the way the war is concluded, it would be the first time territorial aggression has been legitimized by the US, the world power, since the conclusion of World War II. So that puts us in a whole new world, a much riskier world. Obviously, you know, there's all sorts of disputes and territorial claims of countries around the world. You know, if you start getting the US legitimizing that creates a much riskier world, and with that, elevated defense spending is going to be the continued need of many countries who feel threatened by this much less certain world. And then also the other aspect of the conclusion to the war is, kind of people bring up, is, you know, obviously demand from Ukraine itself. I think we moved beyond that. Obviously, you know, in the early days of the war, key driver was donation of equipment, and obviously then replenishing that equipment from European countries. But now there's been a complete sea change in European understanding. So it's not, you know, the real driver of European defense spending now is not simply to provide what's needed for Ukraine. It's essentially realization that Europe basically made a mistake, so to speak, in the post-Cold War era in terms of not having strong defense spending, of allowing their militaries to basically weaken, and obviously having inadequate stockpiles, because that's a key part of when, you know, the war started in Ukraine, was realizing the rate of use of some of this equipment had been stockpiled far exceeded what Germany, Britain, France had used in the past for, say, for example, their engagements, not Germany, but France and UK, in, say, the war on terror, far exceeded the use, and realizing that they weren't ready for this kind of large-scale conflict returning to Europe. And then the other part is, it's become very apparent the dependence on the US and unreliability of the US. Obviously now Trump seems a bit more engaged in European security, but now European leaders can no longer kind of just hope the US stays engaged as both a fully fledged NATO member, backing Article 5, and fully committed to European security in the way it has been since 1945. That's a major risk. Whether Trump, kind of it seems now Trump has kind of backed away from some of those threats, but we don't know who else is going to be elected president in the United States in the next few years, next decade, and that Europe has to really be able to stand on its own feet. And that's not going to go away simply because the war concludes, even on a relatively favorable term for Ukraine, if that was to be the case. So that the European aspect, and then globally, I have this table up here. I think it's part of kind of understanding. We're in a new geopolitical climate essentially. The US and China. It does seem the US and China are less hostile actually now than they were as was expected with the re-election of Trump. If you saw the draft for the national security strategy from the US, they talk about well, don't necessarily say outright, but it's much more focused on domestic concerns and the Western Hemisphere concerns than, say, the US continuous dominance in East Asia. So there is, the question of that continued tension between US and China and where that will go. But we are basically, I would say, we're in a big power transition era. So you kind of see these briefly throughout history, and it creates this instability where obviously the US has been the unrivaled power since 1991. In the 2010s, that started to become questioned post-financial crisis. China became much more assertive in the South China Sea. Russia invaded Ukraine for the first time. And so, the unipolar moment for the United States ended, and you have these new actors emerging who wish to pursue territorial order changes in their own regions and are committed to basically diminishing the US's role as the world power. Now, whether it's the US deciding to kind of push back against that and spends much more on defense, or it's other countries in the region which now, with that absence of the US as the world guarantor of security retreating, feel they need to spend much more themselves. So, if we consider Chinese defense spending in the last 20 years, so back in 2005, they were spending 80 billion a year on defense. They now spend officially 314 billion a year, according to last year's figures. A lot of people think it's actually higher, and they don't fully disclose what they're spending. But if we just take these figures at face value, and then we consider what other countries in the region are spending, India, South Korea, Taiwan, Japan. Obviously, they're much smaller economies, with the slight exception of India and Japan. But they're spending way less than China, and they're nowhere near spending what China is spending. Obviously, the question is, what's their view of the world with a less prominent US? Would say South Korea simply acquiesce to a Chinese-dominated Asia? Maybe. Would Japan? Not sure. Would India? Very unlikely. India itself provides itself as a rising power in its own right. But this is simply speculation in the future. We think all these countries are going to be spending more on defense simply for this less certain world, both to appease the US if they're allies, South Korea, Japan, Taiwan, or India, who obviously have their own designs in terms of becoming a major great power.
Thank you very much, Tom. It was very insightful. So thank you very much for all this detailed information. I didn't mention before, but defense is actually one of the most popular themes here now in Poland. Especially on EF Atlas, it was the most popular theme last month. So I'm sure that this detailed information will be very helpful for large part of investors in Poland. So thank you very much.